Thank you for joining us today. My name is Omer Vandewever from St. Joseph's Healthcare in London. Our presenters today are Robert Leyland and Helen McCauley from Family Services Credit Counseling. Their presentation is an overview of the RDSP and Disability Tax Credit, and I'll hand it over to you.
Thank you. It's good to be here this evening, an opportunity to spend some time with you. We're from Credit Counseling, Family Service Credit Valley. We celebrate our 50th year this year, so we're very excited about that. So we're here in London. Sorry, Robert?
Your computer is muted at this end.
Oh, I have to do this all over again.
You ready?
Thank you.
Thank you. It's great to be here this evening and an opportunity to share with you. I'm from Family Service Thames Valley. We're with the Credit Counseling program there. Credit Counseling Thames Valley itself is celebrating 50 years of working in the London, Middlesex, Oxford, and Elgin is the areas that we serve. Started in 1967, so it's been a few years. I was very little then. Now, we'll get going this evening with our overview. There we go. Sorry about that. Technical difficulty. Want to acknowledge tonight Portland Law and Prosper Canada for giving us the basis of the presentation. Portland Law was contracted by Prosper Canada to help put this together. We've taken their presentation from a little while ago and adapted it for this evening. So we thank them for helping us out tonight. Just a disclaimer, the information provided in this presentation is not legal or tax advice and does not create a solicitor or client relationship. The presentation is for general information purposes only. While we attempt to convey current and accurate information, we make no representations or warranties of any kind, express or implied, about the completeness, currency, accuracy, reliability, suitability, or availability of the information. Any reliance you place on such information is therefore strictly at your own risk. So here's where we're going to go this evening. We're going to start off looking at the disability tax credit itself, then do an overview of the registered disability savings plan, provincial disability supports, a little bit on trust planning, some other considerations and next steps where you can go from that. I'm very excited to have Helen work with me tonight on this. We don't often go out together to give presentations. Helen's going to bring a little bit of expertise from a personal experience and working with one of her children. So this will be beneficial hopefully to all that are here tonight and all that are listening on the web. A couple of terms, just so we're on the same page. The concept of a tax credit. It's an amount that reduces your taxes owing. Usually it's a set amount. The value is the same irrespective of where your income level is. If the person doesn't have taxable income, there's no value to it. Deductions, it's an expense incurred that is deducted from the income to reduce your taxes. It usually requires a receipt and it's worth more to higher income earners. And finally, a benefit, a social benefit is that it's administered through the Income Tax Act, and a good example of that would be the Child Disability Benefit, or as many people are familiar with, the Canada Child Benefit. They just changed that this year, so I'm getting used to the new name. So the disability tax credit, we'll start there and what its requirements are. And with the disability tax credit, we'll call it DTC for short, it's intended as a fairness measure in the Income Tax Act to help offset the cost that those with disabilities would have, additional expenses that are associated with severe and prolonged impairments. There's no age limit to it, so you can apply at any age. You may be claimed by the qualifying person themselves, or it can be transferred to a supporting family member. It may be claimed for the previous 10 years under the fairness provision of the income tax. So if it's not something that you have claimed to this point, but have had this disability for a number of years, you can go back from now to when the disability started and gain a little bit of a refund through the income tax system for those expenses incurred. The individual must be blind or require life-sustaining therapy, or The effects from the impairment are markedly restrict the ability to perform activities of daily living, and the physical or mental impairment is severe and prolonged, and a medical practitioner has to certify you for the above conditions. So it's a little complicated. So when we look at the whole disability tax credit, it's very advisable to get some help working through it. There's a lot of stipulations put on it. It's something that just takes some time to work through. What we find in our office is often people give up, and instead of giving up, we need to have people reach out, and there are a number of good organizations in the communities throughout Southwestern Ontario that are willing to help people with this. One of the recent changes that's helped in regards to working our way through the disability tax credit is that as of the federal budget this year, nurse practitioners are able to certify the form, which is a T2201 disability tax credit certificate. Up until this point, it always had to be your medical practitioner or doctor. They've opened that up a little bit to make it a little bit easier and help people through the process. So, markedly restrict. I'll let you take over from there.
Okay, hello everyone. So when you read through this application and from my own lived experience, it was quite intimidating, and I thought my son doesn't qualify for this. But I pushed through because I was encouraged to, because the definition sounds harsher than it really is, and I encourage you to try. And in my son's case, he has some developmental delay. He works in the community, he votes, he makes decisions. He has ADHD, yet he has qualified as a young child to have this disability tax credit and still has it today. So I really encourage you, it's that you can save a lot of money. But when you read through it, it says things like unable to perform a single basis activity of life, mental function necessary for everyday life, feeding, speaking, hearing, bowel, walking. So you get to there and you kind of go, oh my gosh, right? Like push through and fill out the form and get it approved. Now it's a cumulative effect. So if you have more than one issue going on, it's important that your physicians or caregivers all state the issues, because they will look at everything as a package deal, and I encourage you to do that. But basically the restrictions must be present. So in my son's case, his ADHD is always present and it affects his quality of life. Thank you. So it's prolonged, right? It's continuous for him, more than 12 months. And again, I was very fortunate to have a very supportive practitioner in my life who was willing to fill out the forms and take the time to word it properly. And thankfully, they've opened up the door for that, and more physicians and people can do that for you. I must say, in my experience of working with good clients, good folk, where we are is that we do hit some roadblocks sometimes with the medical teams. They don't understand how this works, and they get through that first line and go, no, you don't qualify, I'm not going to do this. So there may be a bit of education piece that you're going to need to do with your medical practitioners. Hopefully not. I think they're getting more informed on that. Yes. 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 So sometimes it's about educating the practitioner that they're not making the decision. They're writing down their diagnosis, and then our federal tax system is going to decide whether or not the client's eligible or not. So they're not sticking their neck out, right? But the benefits of the disability tax credit are huge. Not only will it reduce tax payable, if not for my son, whose taxable income is ODSP, he has no taxable income, but it's a transferable tax credit to us as a family, which means that we pay less tax. And in reality, our expenses are higher because we have someone living in our home who has special needs. The retroactive is an amazing piece as well. If people have delayed doing this, in our experience, we meet people with debt. And by doing this and going back 10 years, they're able to clean up their debt, or they're able to, at least have more cash flow month over month for the essentials of life. To have the disability registered savings plan, one of their criteria is you must have the disability tax credit. So this is the starting place for this benefit. And we're going to talk more about the disability tax, disability savings plan later, and how that will benefit you as well. But it's a gateway to additional tax credits as well. Not only will you get a tax credit for that, but it comes into, and that's what's listed above, a firm dependent caregiver amount, family caregiver amount, supplement to working income, enhanced medical expenses. We're going to talk more about these as we go. Enhanced child care expenses, age limit extension to children's fitness and art. Then there's the child disability benefit, that there's a top-up that's available if you have the disability tax credit. And of course, Canada Pension Disability benefits are available as well. So it's kind of the gateway to all this saving money. Most provinces also parallel this tax credit. So federal government gives you a break on your federal tax, and then the provincial governments give you another break. And each province is a little different in how they manage that. So again, but it's all benefits in the long run. So for example, in Ontario, it's the provincial disability amount is $8,088. That doesn't mean you get $8,000. It means it's a percentage of your tax bracket. And we're going to talk more about that later. And that's what we're talking about here. So this demonstration is your federal tax rate. So, you know, we're used to understanding our complete tax rate, so our federal and Ontario tax. So basically, whatever your total tax credits add up to, federally they're reduced by 15% of that amount. So it works out to, if you look down, the disability tax credit federally is $8,001. That's about $1,200 in tax savings a year on the federal side. And then the Ontario side would then do their percentage based on what they get. So, you know, $2,500 a year, perhaps, right? Maybe $2,000, depending on income and tax bracket. So it's a little bit of a case study for you, just to kind of demonstrate it a little bit. And so Bill and Linda are married and live in Ontario, and they support a 34-year-old son with a developmental disability who lives with them. Trevor currently receives ODSP and has never applied for the disability tax credit. So if Trevor applies and qualifies, Bill will receive that disability tax transfer, and again it talks about $1,600 for his tax bracket in 2016. And as Trevor qualifies since birth, Bill is entitled to go back retroactively to the previous 9 years. That will generate tax refunds. And also at this time, he could go back and get the caregiver tax credit. Remember I talked about there's other tax credits available depending on your situation. So he was able to go back to 2012 for that one and also get a refund. So it's complicated, it's complex, there's lots of papers to fill out to do this. You might want a tax planner to help you. Yes.
That's something they brought in, and that's why you don't go back that brand new credit. So having professional help is essential to keep up on something that's taking place so that you can get the benefits that you may need or
Yeah, and I mean, and if you do use a tax preparer, I would encourage you to inform them of your situation. A lot of times they're not going to ask. So then they don't know about your situation and the application for these disability tax credits. So the next is the medical expenses. So I mean, I think most people are familiar that we can reduce our tax a little bit with adding up our medical expenses and putting it in. But people who have disability tax credit, there are more things available to them to reduce their tax bill. So again, our government has given a bit of a break towards reducing expenses, and we're going to do an example of that. I mean, obviously, it's refundable for lower income. It's a better refund than for higher income. And it talks about group home expenses, nursing homes, special schools, and institutions. So there's quite a bit. It's a benefit to you. And this is on medical expenses, and it's talking about Trevor is in high school, and Bill paid $8,000 annually for 3 years for tutoring services to supplement his education. Because they had the disability tax credit, Bill was able to claim the full $8,000 each year as a medical expense. Doesn't mean you get your $8,000 back. You get a percentage back.
We look at resources, and I know they're hard to write down. Do we have a printout at the tables for everybody? And those who are online can look at them. But Canada Revenue Agency has a lot there for you to kind of work through, and they're very good at supplying information. As a matter of fact, they're very good. I know people complain they're hard to get hold of sometimes, but when you get hold of them, they're very good at answering questions. So if you have concerns or anything like that and you're not sure what to do, don't be afraid to pick up the phone and just call them. They're there to help you. We have this when we meet people with debts in our office at the credit counseling side of things. People are very afraid to phone CRA for whatever reason. And when we get them to make that final phone call, they go, wow, they were very helpful. And that's what you'll find in this case too. So there are some resources for you that you can go look at, and you can also contact them individually. So from the disability tax credit, one of the things that opens up for us is the RDSP. So that's the Registered Disability Savings Plan. It's meant as a long-term vehicle. It's designed for persons with disability, and we're thinking years down the road. It's one of a range of financial and estate planning tools that if you find yourself with a disability tax credit, you should be taking advantage of. There's a lot there for you. So contributions are limited to $200,000. They're not mandatory, but your personal contributions can go up to $200,000, and the government will match those contributions. The max that will max out at is $90,000. So you can see from starting for somebody at a younger age, the earlier you start into this, the more it will grow and benefit the person. Withdrawals, they're in a, may be limited by a formula, so you have to pay attention to that. You want to be able to deal. It's very specialized. So you're probably not dealing with the first person you meet at the bank. Some of the banks in town have specialists at their main branch that deal with RDSPs. That would be a great place to get hold of that person. Other banks I know will have you phone down to Toronto and talk with someone on the phone. So when you start dealing with the Registered Disability Savings Plan, make sure you're getting a specialist, because it's a great tool, but it's very complicated, and again, people sometimes get lost with it. Maximized if started 10 years after the government's last contribution, meaning that if you were to start taking funds out, withdrawing them out before 10 years after the last contribution by the government, in their withdrawal formula, there's a clawback on some of the grants. So when I say long-term savings vehicle, to help you out, we're talking long-term. You're going to want to leave any money in there from the government for at least 10 years before you start withdrawing it to maximize your benefits. Just some terms again with the RDSP. The holder, that's the person who sets up and manages the RDSP. For minor children, it could be the legal guardian or a parent. And then the person, when they become an adult themselves, they would become the holder and look after it, unless they would have to have a legal guardian who would then continue to fulfill that role. For adults, they would have there's be a beneficiary. That's the person that's going to receive it. A person appointed by the beneficiary using a power of attorney. It could be a parent, a spouse, a common law partner of the beneficiary, a person, entity, legal authorized on behalf of the person. So two different ways. So the holder for minor children is usually always somebody else. The holder for the adult, when we're talking about that, could be any person from that list, depending on their ability to control or whether they want to sign power of authority, a power of attorney over to someone else. So eligibility, so the beneficiary, the person who will receive the benefit and proceeds to the RRSP, you're eligible for this if you're a Canadian resident, you've qualified for the disability tax credit. Okay, we stated that several times. That disability tax credit is really a large gateway for many benefits, so it's important to get that. You have to have a valid social insurance number, and you have to apply for the RDSP before the end of each calendar year, or apply for RDSP before the end of the calendar year in which you turn age 59. The last time you can apply for government benefits is age 49. The government stops giving any money at that point, but the RDSP, for any money to go into it, you have had to open it up before the age of 59. I'll let you take over with your experience. Yes?
So some of the things that I like about the RDSP for my son is that anyone can contribute. So a grandparent, through their estate planning, could gift money to my son. Because he is an ODSP recipient, he's not allowed to have assets. If he has assets, he loses his ODSP. So this product allows us to invest gifting money for him in a protected, legitimate way. There is a lifetime contribution. I don't know that we'll hit that $200,000, but I'm going to aim for it. There is no annual contribution limit, so we can put more in there, but I'm going to talk a little bit about how the grants work, and I'm trying to work those grants, that free money, as best I can for Matthew's future. And as Robert mentioned, contributions are not tax deductible. So this isn't like a registered retirement savings plan where we get a tax break in the year that we contribute. It's more set up like the RESP, the Registered Education Savings Plan program, where we're putting in after-tax dollars. So when we take that money out, it's tax-free. Where we'll pay tax, where my son will pay tax, is on the grant money and the income earned on the product. But when he does withdraw, his income is so low that his tax rate will be very low, and I think the trade-off is okay. We can continue to contribute until he turns 59. He will eventually have to start withdrawing money from this program, so I see it as a retirement fund for him, and an opportunity when I am old and gray that I may not be able to be around or be able to support him financially, that this will. And this money will not affect his ODSP. So his income is protected. It's creating a safety and security. So there's two types of contributions that our federal government gives to us. And one of them is a grant, which comes through as which is based on, what we pay into it. And it's based on family income thresholds. And in my son's case, it's based on his income alone. But there's also a bond. So the bond comes to him whether he contributes or not, and it's $1,000 a year. And it was retroactive, so I was a late bloomer in understanding this product and didn't start from the beginning. But they went back to 2009 and gave him all his bond money. You have to do your tax returns like many of our government-funded programs. You must do your tax returns to qualify. You can't base what your grants are going to be if they don't know what your income has been. And again, so you have to file your income tax for 2 years prior. You can apply for Canadian Child Tax Benefit if it's a child, and the grants and bonds are paid until the year that they turn 49. So, we plan on maxing that out every year until such time. So the contributions are based on until the year they turn 18, and it's based on family income at that time. So if you have a child that you're doing this for, the contributions the government are going to give you are going to be based on the family income. Once the beneficiary is 19, it's based on their income only. And if they're married, obviously adjusted family income. So that's the slide. We're talking about how the contributions work. It's a busy one. Basically for my son, we're maxing out his contribution of $1,500 a year, and we do it monthly through a savings plan, and he gets his $1,000 grant every year, and then he gets a $3,500 grant every year, and then he gets his bond. So for $1,500, he is saving $6,000 a year towards his retirement income, right? So again, the disability savings bond is that $1,000 number, and you do not have, you don't have to contribute to get that. So even if for 20 years that's all a family could do, there's still $20,000 plus income. earn from that product. And then it talks a little bit about family income and how it works, right? So it's a staggered thing. There is a carry forward option, so we have some catch up to do because we started late. So, you know, and it tells me on his tax return what my carry forward limit is, just like our RSPs show you your carry forward limit. And our goal right now is to do the 1,500. I mean, we'll have to be realistic about what we can do, but that's where gifts and grandparents come in, and perhaps we'll be able to catch up over the years and participate fully. We plan on doing this until he's 49, and look at it at that point and decide whether or not we want to continue to contribute our own money at that time. Honestly, I'm mostly attracted to the free money. We'll talk about at 49, we'll have to make a decision on whether we'll continue to invest there. One of the things that I like about investing there is if it protects his ODSP, he gets a windfall, obviously that's where it needs to go. So we protect him in other ways. So we have an example. So this is a new RDSP opened in 2017, and Jane is 35 years old, and her family income has been 0 since 2006. So it talks about the unused grant room and bond money. So eventually, you know, that bond money is going to drop into her account. She's going to receive that $10,000. The grant money will depend on how much she contributes. And remember I talked about the $1,500 limit for 6. This is where they're talking about she's got an annual maximum of $10,500 that she can put in and participate in grants. And this is a break.
Yeah. We just want to break for a few minutes and we'll gather together and we'll get through the rest of it. But as you can see from that very last slide, one of the benefits from the last slide is the ability to catch up. And that goes back to where we get private help. So again, from grandparents or from family members or somebody who wants to contribute, they're able to do their part to sort of push you forward to maybe catch up on those inside the grant area and then maximize out your benefits. So the RDSP, especially if you're working within a family group, can be very beneficial in protecting, but it can also be very beneficial in setting someone up for a more financial security upon retirement. So we'll meet back in about 10 minutes. Feel free to get a glass of water or whatever you want to do. Thank you.
Yeah, welcome back. So the next portion is around how to make withdrawals from an RDSP, and there's lots of rules, of course, right? And there are options around early withdrawals for sure. I think some of the key things to understand is if you do early withdrawals, you potentially can lose your grants and your bonds. And I call it a vested time. So the bonds come to you, and if it's more than 10 years, you get to keep the bond. If it's less than 10 years, you're going to lose it. So they talk about every dollar that is withdrawn, a repayment of $3 to the total amount of the bonds or grants must be made. So I guess if you're desperate and you needed your after-tax dollars you've invested, you can get at it, but the trade-off is you're compromising the free money. So there are different ways of doing it. So there's the lifetime disability assistance payment, and I liken this to creating an income stream for my son. So it would be regular withdrawals like you would with an RSP when it goes to a RIF, becomes a form of income. It can begin at any age, but must begin by the end of the year the beneficiary turns 60. And that amount is a formula, and it'll be based on how much is in there, of course, and I'm sure they have, like they do with RIFs, figured out timelines to have it exhausted. And it does take into account the fair market value and the beneficiary's life expectancy. So, you know, that's a very attractive way of creating supplementary income to help support someone at that age. But there is also, so if something happens that my son becomes unwell and has a short life expectancy, there are ways of withdrawing funds at that point so he can benefit from it at that time. Obviously, a doctor has to certify it, and there may be the 10-year repayment rule may apply or may not apply. And then there's also the disability assistance payments. So that's unscheduled lump sum withdrawals. And that's part of one of our thoughts is that at age 60, I'm telling my age, I'll be 85. And we wonder if we'll have enough there to perhaps purchase a small condo apartment that he would have independent living in a very cheap way. That's kind of one of our dreams. Not sure what that, we'll review that when we get there. But the downside of doing a big payment out is that we'll pay tax on the full amount taken out. So have to get there. So earnings, so tax, how we are taxed on this, the earnings grow on a tax deferred basis. So that means as you earn income on your investment, you're not taxed until you withdraw it. So the grants, the bonds, and the growth on your money is taxable upon withdrawal. The amount that I put in or my son has put in is not taxed. You've already paid tax on that money. We can withdraw it tax-free. It'll be the growth and the other investments that will happen. So we try to do an example here that you have an RDSP for $100,000 and privately we've contributed 30%, $30,000. The government has contributed $60,000 matching, and then there's been $10,000 in growth. So if we withdraw $100,000, 70% of that, the $70,000 is taxable income. Some of the other benefits that I really like about this product that if my RRSPs outlive me, that by designating beneficiary-wise correctly, my RRSPs could transfer to my son into his RDSP tax-free. So that's something I've set up, and so that's a way of transferring over more assets to him and protect him. And again, yes, you can.
That transfer of money to the RDSP or for the income fund at that point.
Yes.
That is something you designate as a beneficiary with your financial investment plan. Right?
Absolutely, yes.
So it's not like involved. Whether it's that and you can make designations on those, and that's the financial investment plan. I don't think it's a real big deal. It's very simple. It's not going to cost you anything. And you can make multiple beneficiaries. So if you have more than one child, you can simply say where they're going, how much is going to each child, a dollar amount per percentage.
Right.
Right?
Right.
Okay,
Yeah.
just want to clarify.
Yeah. So RRSPs and RIFs, the only other time funds can be transferred tax-free is if you have a spouse. At that time of death, you can do it then. So this is another way of transferring assets tax-free. And again, the 200,000 lifetime maximum is there. I'm not in too much danger there. But it will allow you. So there's also rollovers with RESPs too. So if you've started a registered education savings plan for the beneficiary and it doesn't get used, they're prevented from doing post-secondary due to their disability. There's conditions, of course. It has to have been open for at least 10 years. They're 21 years of age and not pursuing post-secondary. And it talks about the RESP is open for at least 35 years. So there is a rollover allowed. My understanding is your contributions would get rolled over. You would lose the grants. The grants and bonds are returned to the government. This product is set up, reminds me very much of how the Registered Education Savings Plan is set up too, because you would lose your grants in an RESP as well if your child didn't go on in school. That goes back to the government. Provincial programs. So one of the big draws for me is the provincial program of the ODSP, Ontario Disability Support Program in Ontario. Does not impact my son. This, when he starts getting income from this, they will not pull back on what he gets there. And that was very important to me, that he could continue to have that. And the asset is exempt because there is, under the ODSP guidelines, they do have criteria that he must meet on income and assets to even get ODSP. Then again, the income, so the funds received from RDSPs can be used for any purpose as long as they are to the benefit of the beneficiary. And then there's a partial exemptions applying Quebec, New Brunswick, and Prince Edward Island. So every province is going to have a little bit of a different view on this, and it's important whatever province you're from that you become informed. Federal programs, so anyone on ODSP remains on ODSP until age 65, and then at that time they convert their incomes, go to old age security, guaranteed income supplement, Canada pension, and HST benefits. And again, the RDSP will not impact these programs. So he's not going to lose income on another end to have this. So closing an RDSP. So if the beneficiary passes away, the RDSP must be closed by the end of the following calendar year. Any grants or bonds received within the last 10 years must be repaid to the government. That's that 10-year rule again, right? You'll lose anything in that last 10 years. Original contributions are not taxable. We've put money in there with our after-tax dollars. It comes back out non-taxable. The remainder is taxed to the beneficiary's estate. So, and that happens with RRSP withdrawals or our RIF when we pass away with no beneficiaries. If it goes to our estate, it becomes taxed. So it's no different. I mean, they've set it up really as fair as they can. The beneficiaries pass through the estate, so the proceeds pass through the estate of the beneficiary, and then according to the will would be processed from there. I guess there could be an opportunity that the beneficiary might lose eligibility, and then the rules are that it must be collapsed and that any bond or grant received within the last 10 years must be repaid to the government. Proceeds become an asset of the beneficiary and which could impact the ODSP. Original contributions are not taxable again after tax dollars been in there. The remainder is taxed in the hands of the beneficiary. As of 2014, RDSPs can remain open, but are dormant for up to 5 years. And a medical certificate that would have to be supplied with the likelihood that the eligibility in the foreseeable future is required. You cannot make contributions during that time, and no government contributions are paid or accumulated. So it sounds like it can go on hold if need be. And here's some more resources to read more about it. It's a complicated product. First time I read it, it overwhelmed me. Just keep reading it. Understand how it can benefit you.
Okay, so provincial disability supports. Very complicated again, and that's why we have people in the communities around that'll help you with them. But each province has its own assistance program, and typically the eligibility involves around financial disability rules and disability determination. So rules apply for assets and income levels. And this is what gets most people. It's beginning to understand what those rules are, and they're very important. I believe you can have about $5,000–6,000 if you're an ODSP in a bank account somewhere, and then you can have an asset up to,
You can own a home.
you can own a home.
Yeah, you can own a home and a car. And recently, inheritance up to $100,000, not go over $100,000, or they lose their disabilities. But you can have, they cannot have more than $5,000–6,000 in a bank account.
So it pays to understand what the determinations around the finance eligibility rules are and staying within inside of those. We do find from time to time, because of those eligibility rules, people will lose their ODSP for a short period of time until they come underneath those thresholds again, and that gets frustrating, especially if you see somebody afterwards and they don't understand some of the other places where they could put money and protect themselves. So getting to understand what's there and what's available is very important. In Ontario, we have the Ontario Disability Support Program. It's an income support that provides people with substantial physical or mental disabilities that are expected to last more than a year, and it affects their ability to care for themselves and or take part in the community or at work. So if a person's 18 to 65 and they're struggling with work and they're struggling with just being able to, well, it's for different reasons, but either physically unable to work, or it can be a mental health issue or anxiety issue, they're able to apply for the Ontario Disability Support Program and get an income support from there. Income depends on the size of the family, income and assets, and housing costs. One of the key drawbacks of the program that some people find is that they may have been working for a number of years or injured and need to take part in the program, and they have a spouse that is working and the family income is above the threshold, and therefore they're not able to collect anything. And that gets frustrating for a number of people. But again, it's being aware of what those thresholds are and taking advantage of what you can through the system to help you out and to move your family along. And when I use the word taking advantage, I mean that in a good way, not in a bad way, but in a way of helping support your family as you move through on this journey. Determination is again based on financial ability as well as disability. There are some assets exempt. We've talked about them already. Principal residence, the RDSP, RESPs, and some non-exempt assets and income would be something like a CPP or child support. So if you've qualified for ODSP and also apply for CPP disability and you're granted CPP disability, you will lose a portion of your ODSP. The benefit to having both for many people, especially for those under the age of 65, is that all-important drug card. The ability to be part of the drug program and receive the medications that you need not having the strain of having to pay for those out of pocket. So if I have people that have already come into our office and they've already been able to manage to get the CPP disability, which is rare, but I have seen it, I encourage them, if they haven't already tried for the ODSP, to go back to the ODSP and try again. And in that case, they're not necessarily looking for the income support, but they're looking for some of the benefits, such as the Ontario drug card that would help them out. Estate planning. So what is estate planning? It's very important for anybody, but very important when you start dealing with these different products that we were talking about this evening. It's the arranging during the life for the management and disposal of that person's estate after death or becoming incapacitated. So this is, and Helen's made reference to this throughout the evening, not only is the estate planning for her, but there's estate planning for her son who she's working for. So it's the transfer of assets from one person to another in an orderly fashion. So It's your legal instructions. It's a manual of what should happen to the estate. It's designed to ward off uncertainty for those that are left behind, but it's also designed to take away some of those tough decisions. It's to pass on wealth from one generation to another, minimizing taxes with very little legal difficulties, and trying just to make that a smooth transfer. That's what we're looking at when we talk about estate planning. So how does a trust work when we talk about estate planning? A trust, and Helen's going to speak to the different trusts. Again, she has life experience in them. But a trust consists of three people. You have the settlor. He or she puts the assets into the trust. You have the trustee, a person or a company that holds the assets and controls the assets. And then you have the beneficiaries, the individuals that benefit from the trust, whether it's one or two. So that's essentially what a trust looks like and how it works. Using a trust. A trust is created when ownership of assets are being transferred to a trustee, which again could be an individual or a company, with instructions of how they're to be used to benefit the beneficiary. So they come with an instruction manual, both by the person leaving behind and a bit of a legal instruction manual of what the law will allow you to do and not to do. So there are two common types of trusts that we see. One's a testamentary trust. So it's created in the form of a will and takes effect upon death. The assets relating to a testamentary trust are part of the estate and are subject to any applicable taxes or estate fees. And then we have what we call, and I'm not even going to try to pronounce that properly, commonly we call it a living trust. They're not as popular in Canada, and that's due to how they're taxed here in our country. You'll find if you're listening to things from south of the border, they refer to living trusts quite a bit. Here in Canada, a living trust is taxed at a higher rate than a personal tax rates. We tend not to use those. Trusts are complicated, and I can't say enough, the advice of a competent lawyer should be consulted. You need to find somebody when you're setting these up who understands them, that's a professional, that takes the time to work through. They're not just something to be entered into lightly. So, common uses for trust. So if you have children from a previous marriage, you may have a trust set up to look after those children. Your spouse may lack financial expertise or ability or competency to handle the finances when you're gone. You would set up a trust. If your spouse or child is disabled, you may want to look at setting up a trust to protect them, protect the assets you're trying to transfer. You may want to provide a gift for minors. So again, you would set up a trust through your will. They're set up for tax planning purposes. You may want to provide a gift to a charity, and it's something that you may want to use to help bypass probate, which can hold things up for a very long time upon someone's death. So 3 common trust types that we're going to talk about tonight is a Henson trust that's used a lot when somebody is passing wealth onto somebody with a disability. There are provincial variations on them. Then there's the Qualified Disability Trust, which is federal, and the Lifetime Benefit Trust. And as I said, Helen has some experience in this area, so we'll let her address those trusts for us.
Yeah, so in my will, I have, there's a special wording that's in there that's around this Henson Trust. So this will allow, if I died with wealth, would allow again to protect my son's other assets and income by creating a trust fund for transfer of his money into a Henson Trust, which then would be managed for him, and he would receive the necessities of life from that fund. So it is called an absolute discretionary trust. It costs money to set up if you have to get there. So there, this is, probably people with over $100,000 in assets to transfer to a disabled child, especially now that ODSP will allow them to have some investments from inheritance. So it's not considered an asset, so it doesn't compromise income. There's no monetary limit, so that means they can be very large. And it could be a living will, or so the vivo is your living will, and then the testamentary is your trust upon death. And you can have multiple trustees, so it could be set up for an entire family, I suppose, if you wanted it. What's important is you need to get your estate planning done and be open and honest with your lawyer around why you're doing this and understand why you're doing it. And it just basically is a very specific wording legally that protects assets from exposure to the ODSP income. And that's why I've done it. This qualified disability trust, so this allows income to be taxed at a graduated rate. And in order to qualify, you must be a resident of Canada. One beneficiary must qualify for the disability tax credit, and trust capital cannot be paid to a non-qualifying beneficiary. So the beneficiary can only benefit from one, so you can only have one of these. So there's thoughts, certainly you need to talk to probably an investment specialist as well as a lawyer to understand what the right product will fit. But there are options, and that's what I want you to walk away with, is that you have some decisions to make. So the Lifetime Benefit Trust allows for the rollover RSPs and RIPs to a trust on a tax deferral basis. And in order to do so, the beneficiary must be a child, grandchild, spouse, or common law partner. And the child, grandchild must be dependent on the deceased at the time of death due to a mental disability. And the Lifetime Benefit Trust named as the annuitant is of qualified trust annuity. So another way of perhaps protecting your RRSPs through a tax deferral program. So there's a lot to consider, right? When figuring out who to select as your trustee. They must be honest and trustworthy, highly involved in the beneficiary's life, sensitive to the beneficiary's needs and wants, and understand the social assistance roles in your province. How old are they? You don't want to pick a trustee that's older than the person. Has knowledge of investments in income tax, is good at record keeping, and be aware of potential conflicts of interest, right? I was a trustee. I have a brother that passed away, and I was his trustee as well, and kind of was all here. I have appointed with my other sons, I have two other sons, they will be my son's trustee. There will be a learning curve, for sure, but they'll take care of them, if need be. And additional considerations?
Well, I think it's really important.
Yeah.
Many times when we're looking at sort of that estate planning picture, having that person there or persons that have an interest in that other person's life and are going to look out for his best interest is huge. But there are other considerations to take place. Life insurance is a big one. Do you have a named beneficiary? Do you have it set up properly so that when it transfers over, you're not going to get exposed to a lot of unnecessary losses, or the person that's receiving it is going to have a lost income? Banking arrangements. I guess probably the best example I can give for this is as you read through them. I did a seminar on estate planning specifically a number of years ago for the Boys and Girls Club here in London, Ontario, and it was to deal with setting up a will and the different things they would need for that. And the importance of all that wrapped around this one issue. I had one older couple that was there, and she called me probably about 3 months afterwards. And she called me up and she said, "Thank you." And I said, "You're welcome." I didn't know who was on the other end of the phone at first. And she said, "After your seminar and talking about making sure the life insurance was arranged properly, that the banking arrangements were arranged properly, so that things would transfer quickly into the other spouse's name." We went there. We went to our banker. We talked to our financial people. We talked to our lawyer. We redid everything so that it was according to what you had presented that night. My husband died a month later, unexpectedly. Unknown to her, prior to them redoing everything, he had financed their retirement in an unconventional manner, and he had debt. And well, we added up the debt of the credit cards and everything that I was getting between $75,000 and $100,000. Many cases, because they had it set up right, there was nothing left in the estate and everything transferred into her name. All she had to do was provide them with a death certificate. There's nothing in the estate, debts don't transfer, that was the end of it. So the leased car went back, And the credit cards are calling the line of credit. We're handed death certificates. The house transferred automatically into her name. So it saved her a lot of grief and heartache. When we look at some of these additional considerations, whether it's the life insurance, the banking arrangements, home ownership options, self-directed support groups that you want to get them involved with, accessing supports and services, power of attorney, these small details pay off huge dividends. So there are all kinds of support benefits out there for us to take advantage of, community supports to go ask questions to. And for anybody that's watching this, whether you're eligible for the child tax benefit, getting them mixed up already, for the disability tax certificate or not, if you're concerned with where you are and you're not sure you're getting all the supports you need, the Canadian government recently set up this Canada Benefits Finder. The link is there. You can go and plug your situation in there and what's going on in your life, and it will tell you whether or not you're getting all the benefits that you can have to support you at that time. So it's a great system, but remember those other things and take them into consideration as you work through it. It's very important. So next steps. We're looking at it and saying, wow, a lot of information. I think I need to do some study and some research. Prioritize your planning. Don't look at the whole forest. Pick a couple of trees to focus on, a couple of things to do, and start chipping away at it. And it goes right back to what we said at the beginning of our time with you. Sometimes when we look at that disability tax credit, we look at what the wording says, and we get scared of it. Professionals get scared of it too. You want to plug through. So prioritize your planning, where you're going to start. Gather your information. There's nothing that can be said that the lack of information really hurts a lot of people. So gathering the information, getting to know what you're talking about, understanding it, sitting down with people. We have people that come to our office when it comes to budgeting and different things. I've had people come back 6 months later and go, okay, can we go over this again? And yeah, sure, we'll go over it again. And it's getting them to understand the information. That information then becomes powerful tools in their hands. Identify your people, who you need to work with, who's around you. Select your professionals. Again, it's very important to have people that have a deep understanding and work with this on a daily basis to help you and guide you through it. And then seek guidance. Professional, those who have walked before you. There are others that have gone down this road, understand it. There's nothing like walking with somebody who has expertise, who's been there, who can encourage you and keep moving you forward. So I think there are important steps to take as you move forward. So thank you. We're open for any questions from the floor. We'll do our best to answer them. And if we don't know them, we don't have an answer for you, I will not feed you a bologna sandwich. I will simply say we don't know it, and we'll try to go look for it and get to the answer at a later time through Omer. You have a question. Don't go away. She has a question.
Okay, so I've written down. Getting the disability tax credit, you have to do that before you get your income tax, or can you do it anytime?
Okay, so the question is getting the disability tax certification or certificate. Do you do it before the income tax or at any time?
You can't use it as a tax credit until it's been accepted. So you can apply any time of the year to get it. Once you have it, then the tax credit can be used at each tax year. So you have to wait till you've been approved to actually benefit from it. And then it's at that point, they'll even tell you how many years you can go back. And then you can start the process of applying it back to different years. Okay, yeah.
Any other?
Did you say that debt is not transferred over? So the person that dies, their debt is not transferred over to the family?
Correct. The question was, does debt transfer? If the debt is only in their name, if it's not co-signed, co-signed debt always transfers to the co-signer if it's not paid. But if it's just your credit card with your name on it and you pass away and there's no money in the estate, then that debt basically dies with the person. They will have to write it off. Now, the credit card company or financial institution may request a death certificate and that's their legal right, just to show that the person has passed on. Okay. A clarification on the question we just had in regards to transferring debt from one person to another. They cannot go back on other people. They will try to get you to pay it. They will give a story, but if you're not on that debt, it doesn't transfer to any other family member. Probably one of the families feel responsible for that, but anybody can get debt together, whether it's in a business. Helen and I could go get joint debt together if we wanted to. Yeah, I know my wife would probably say something about that, but if something happened to one of us, then the other person would be responsible. But in the case of the credit card that I have, if something happened to me and there's no money left in the estate, or it's all, as the illustration I gave you earlier, everything was and completely transferred over to my wife, then if there's any balance remaining on that credit card, it would not be transferable to her or my son's adult children. It would die with the debt, or the debt would die with me. Yes?
If the maximum contribution for RDSP is $200,000, and say you get a settlement from an accidental to the lawyer, and let's say that surpasses that, then that would be best to go to the
Henson Trust. Okay, so if you max out your contributions in RDSP with a settlement, but you still have money left over, basically the question is, what would you do at that point with the money left over if you're protecting yourself?
I do think it's complicated. I would want to get investment advice as well as tax planning advice, but that's where the other trusts come in. The Henson Trust is more transfer of assets upon death, right? So that's my belief. But the other trust may be the right fit for someone that has assets more than the 20,000, right? Yeah, but
no, it's a good question, and that's my understanding of the Henson Trust. It's to protect. Just an illustration of the Henson Trust. I had a woman come in whose mom was very wealthy. She was on disability, was in her mid-50s, and although her mom was in really good health, suggested that she would want to sit down and talk with her mom to be able to protect those assets on transfer. So she called back later, and yes, they had met with the lawyer and set up a Henson Trust. But that's great. You would want to get that extra advice, and hopefully it's enough that maybe you don't need the other income supplements and you'd be able to survive without it. Okay, any other questions? Sure, go ahead.
For the disability tax credit, talk about the qualification test, you have to have total credit 12 months. Well, what happens if the doctor said, okay, you know, if you live on yourself, drive, all kinds of different things for you those for 2 years. If they get the tax credit, then later, 2 years afterwards, if they find out they're qualified and they can go back to work at their, you know, the job and where they accept
Go ahead.
You want to take the question?
Okay. Clara, get the question right. So someone has an injury of some sort, it's acquired brain injury, and is unable to continue working where they were for a period of time, maybe up to 2 years, and then getting the disability tax credit. What happens if they return back to work, but still may have some issues that they're dealing with, such as not being able to drive, or you gave me one other example and I forget what it was now. Extra help with general life duties, but they can resume somewhat of their life. Okay.
Yeah, so disability tax credit can have an end date. So it is possible to have a lifetime one, but it is also possible that you could pre-qualify and not be eligible anymore. I know some disability tax credits they're giving for 5 years or 10-year period and you have to re-qualify. So, right. So I would go ahead and I would apply for it and benefit from the tax credits as you're supporting this person through healing, and review it at that period of time when things get better. Because remember, the disability tax credit will also help reduce taxes paid for schooling, right? For there's an awful lot more credits available that might be of value. Yeah, and let's hope they do get well and don't need it. Yeah.
So if there was retraining or something like that that was needed, then if you had the tax credit, then that comes off as a medical expense, right, what we saw. Yes, it would still benefit from that amount of time. It would be a great use to supporting them, again, on their journey and hopefully back journey to health. Okay, so we have a couple of questions here. If the person is 28 now and he has been diagnosed as disabled 4 years back, he is earning his part and trying his best, can he apply for ODSP and RDSP both?
The answer is yes. So ODSP does have an income level, but people on, good folk on ODSP are able to work. And so basically they do claw back. So each month you have to show your income, and you would have, they do their math and eventually, but yes, you can work. And if you're eligible for the RDSP, why wouldn't you? Because you're going to benefit from savings.
One of the things with the ODSP, it's important that even if you qualify for ODSP and 2 years down the road you find that you've returned to health and your income's beyond the threshold, that's fine. Once you've been on ODSP, it's easier if you have to return to it. Probably one of the best examples was a gentleman that I had seen, and he had in his late 20s, early 30s, anxiety was his issue and was off work for a while. And he did some retraining with his medical professional. They worked through the process, learned some new coping skills. He returned back to work. And he was back to work for about 3 or 4 years, and then he was off again. Again, back to see the professionals, retraining and understanding what was going on, and then he returned to work. I saw him at the end of this return to work. He had returned to work for 12 years. I asked him what happened. He said, well, I got so good at my job, it became very busy where I worked, and he says, it was too much for me. I was too good at my job. So I said, how long are you going to be off this time? He said, a year. So we went back into ODSP, back to the medical professionals. He says, I think I understand what I have to do. And he was now returning back to the workforce. So each time he had to return to ODSP because he was on it once, it's a little bit easier to get him through the system again. So it's something that once you have it, or if you need it for a while, you should make yourself available to it. Use the benefit as necessary. And in this gentleman's case, he was able to return, and he was figuring he could make it to retirement this time because he had learned so much from the previous times. Okay, we have another question here. What's the difference between ODSP and RDSP? So ODSP is an income supplement meant to help you out in regards to having living supports and income supports around you for your life. The RDSP, the Registered Disability Savings Plan, is meant as a savings vehicle for the long term, as you saw with the different clawbacks they have when you take it out. So one is meant for present day, and the other is looking to the future to help supply a better income upon retirement, or if need be, an early withdrawal, if there's one of those other conditions that were meant. And do we have another question, or was that, that was it? So thank you. So thanks for